let's talk a little bit about Footlocker. Shares getting hammered today, falling nearly 28% after this, of course, the retailer posting a very bleak quarterly earnings report, even bleaker the outlook for the rest of 2017. Joining us now from San Diego is Eric Urban, CEO of Reality Shares ETFs. We just showed that stock chart of Footlocker. We saw a straight drop down on the day. Eric, thank you so much for joining us. What do you think are the biggest challenges facing what we had a previous guest called the Hurt Locker, but also known as Footlocker?
A tough market for some of these retailers, not just Footlocker, but Footlocker in particular. Any of these mall-centric retailers, which are really heavily focused on that traffic, which is coming in from the malls, it's just going away. I mean, Amazon is the big story of retail, where disintermediation is happening across the entire retail market, but in particular in these markets where there's really no other reason to go to that store other than because you're at the mall and you're interested in that. So it's going to be a tough market. Footlocker, out of the entire sector, though, actually is a pretty healthy business. So keep your eyes on it because A, they've got a strong management team, and B, they've got a very healthy balance sheet with very strong cash flows. If they can pull this around, they certainly have the bones and the skeleton in order to do it. It's just going to be tough for them, though.
But so time after time, really in these conversations, we've heard that innovation is the thing that's really burdening Footlocker right now, and that they haven't changed really fundamentally from where they started at. Sure, they've tried out these shop within a shop type of installations with House of Hoops. They've really placed their bets with basketball. But when we look at where they are right now and how they begin to shift to compete with an Amazon, or if they just compete and continue to compete against the likes of Ross stores even, what are some of the things that they should be focused on with either of those routes that they need to take?
Yeah, so innovation, I think, is one thing, but you mentioned Ross stores, and I think today's a great example. So we had Ross stores up almost 10% on an earnings beat. We had Footlocker down almost 27% on an earnings miss. And what's different about these two stores? I wouldn't say that Ross is at all innovative. If anything, what Ross has done is they've identified their own market niche, and then they just play to that so well. I think a lot of people think of Amazon as the place that's going to disintermediate solely based on price, but really they're disintermediating mostly because of convenience. And there's still a lot of shoppers that are bargain hunters that are going to Ross stores because of that ultra discount type retailing experience. They can't get that at Amazon, and so that's why Ross stores has been such a strong player. TJ Maxx is another great example of this. They've really been able to take advantage of this. It's not to say the stock's not down, but man, if you look at their cash flow growth, their dividend growth, their stock price growth, that stock has been phenomenal just for decades, really. As long as they've existed, that stock has been just a moonshot all the way.
Eric, let's talk a little bit about the Gap, another retailer reporting not great earnings this week. I mean, Gap is trying to find a way to defy the headwinds facing the broader retail industry, but I mean, I don't see how it could really make a compelling case for its quest of staying relevant, even with Banana Republic and especially Old Navy doing very well in this past quarter, actually performing well, Old Navy specifically 7 out of the last 10 quarters in terms of same-store sales increasing.
Yeah, and I think that's a great example. So you've got the Old Navy brand, which is, again, kind of focused on that discount, on that niche. We bring in the product, and you've got to keep cycling through the store in order to see what's on sale and what's going to come through, what fashion we're going to be selling today, versus the Gap, which is a bit more, if I'm in the mall, I might happen to go into the Gap. I'm not going to make a special trip to go to Gap stores, and just like Footlocker, it's the same kind of example there. I think where people are going to really have to focus here in the retail sector, we've already had a nice sell-off. I mean, depending on the stock, you could be down anywhere from 30 to 50% on the year. It's just going to be important not to catch these falling knives. You want to be very careful and very selective, only buying these high-quality names in this space. But there is a lot of differentiation, like I mentioned about Ross stores, TJ Maxx, Home Depot, some of these others that can really stand this. I guess this just disintermediation that's happening, and then there's going to be others that are going to be gone in a few years.
Now, let's talk about your positions for a moment as well, especially with relation to the ETF. So, when we think about the companies that ultimately fall into your strategy right now, how do they compare against some of those that you've deemed, that you rather rule out and you're not adding to your portfolio at the moment? And specifically, do you really consider TJ Maxx in this fold as well as they compete directly with Ross too? With the subsidiaries of Home Goods and a Marshalls and so forth.
Yeah, so the way, I'll just back it up a step. So Reality Shares is focused, the reason we call it the firm Reality Shares is we really focus on things that are real. And earnings can often be a little bit manipulated. And so dividends become that kind of reality factor of are the earnings really growing? If the dividends are rising, then most likely the earnings have to be rising as well in order to increase. So we look at the dividends, but then second step is look at which companies are increasing their dividends and have the potential to increase dividends a lot in the future. So that leads you to companies that tend to be higher quality, and they also tend to be good performers from a growth perspective. So that's where TJ Maxx was in the portfolio last year. They fell out of the portfolio just slightly. We're all about quantitative analysis, so that you have to meet the criteria in order to make it into the portfolio. Ross Stores, a great example. So Ross Stores has been what we call a DivCon, which is the dividend condition, DivCon 5, which is the healthiest dividend growth stock. And basically, over the past 10 years, it's been in there more time than almost every other stock except for a few. So we have really high quality names in there that have a lot of potential for growth. Home Depot was in there last year. So you see a lot of names like that in a portfolio like this. Walmart isn't in the portfolio, but Walmart would be the kind of stock that tends to be higher on the DivCon rating system.
Eric, for full disclosure, I want to say you do own shares in Ross Stores and in Footlocker, but sticking with the Footlocker, shares of Nike and Under Armour also being dragged down on today's news. Obviously, Footlocker closing down nearly 30% today, but Footlocker, in essence, in some ways, kind of blaming its vendors, Nike, Under Armour, being some of them saying that they're not getting innovative enough products into their stores sooner, saying that's part of the reason that you've seen the sales declining at the store. But if you compare that to Nike in their second quarter earnings report, this company beat earnings expectations. This is even after they decided to cut back 2% of their global workforce. The problems at Footlocker, are they unique to Footlocker, or is this a bigger thing that investors should be focusing on in terms of avoiding athletic apparel and footwear companies?
No, Nike, I think, is going to win in this one. If you look back to a few weeks ago when Nike made that announcement that they were going to start selling through Amazon some of their products, I think that was a big blow to the Footlocker set. It's not an athleisure apparel type problem. This is really, I mean, there's going to be problems across the board in retail. Retail was up overall retail sales were up about 0.6% this year over year, which is okay. It's not bad. It's not fantastic though. And actually, if you look deeper, you see that a lot of that was through credit card debt. And so a lot of people, is this consumer stretched? That's the bigger question. But whether or not Nike and Under Armour are going to make it over, say, a retailer of what could be Nike or Under Armour, I would take Nike every day. I think that you want to own the product company. Nike has basically figured out how to innovate across every different innovation cycle that we've had in the athleisure area. So you definitely want to work on that. And a full disclosure as well, so we do own Nike in our portfolios as well. It's a great dividend grower.
All right, there we go. All the disclosures. Thanks so much for joining us, Eric, breaking down all the retail news of the week. That's Eric Ervin, CEO of a Realty Shares ETF.
Thank you.